Can private equity bounce back? In the last 2 years, rising rates and geopolitical uncertainty have dampened both fundraising and deal activity for private equity funds. Some even question how much more growth the asset class can see in today's higher rate environment. So is there merit to these concerns, or is PE about to turn a corner?
There's no doubt that higher interest rate environment is going to have an effect on private equity returns. So when you think about the next couple of years, we do think private equity returns will be more subdued versus what you've seen in the past.
I'm Allison Nathan, and this is Goldman Sachs Exchanges. For today's episode, I'm first speaking with my colleague, Alex Blostein, who covers the asset management industry and capital markets for Goldman Sachs Research, to discuss the challenges and opportunities facing the private equity industry. I'll then turn to Mike Nichols and Gina Lytle from our global banking and markets business to discuss the evolution of the space and the types of deals that are happening today. All are joining me in our New York studio. Alex, welcome back to the program.
Great. Thanks for having me. Pleasure to be here.
So we all know what's going on in public equity markets. They have been off to the races this year. When I checked my monitor before I left, the S&P 500 was up almost 10% year to date.
Yep.
We're not halfway through the year, so pretty impressive performance. But private equity markets don't seem to be faring as well. Give us some numbers on that and, talk to us about what private equity returns have been doing recently.
Yeah, sure. Thanks for having me again. So you're right. Private equity returns year to date are hovering around 2 to 3%. So below what you see in the public markets. Now, there's important two things to remember. One, public markets tend to be a little more volatile, private equity markets less so. So the starting point here really matters. So if you go back and you zoom out a little bit, going back to pre-rate hikes, so kind of think about the end of 2021. So over the last 2.5 years, the cumulative return for private equity funds has been about 15%. When you look at the S&P, it's been a little bit below that, especially on an equal weighted basis. There's been a lot of conversations around the concentration of public market returns, which is obviously very true. On an equal weighted basis, the private equity funds have done decent amount better when you kind of zoom out beyond the kind of year-to-date results.
But that period pre-rate hikes was an exceptionally robust returns period for private equity. And now it looks like, as you said, not as much volatility in private equity markets, but it looks like there's been some slowdown.
For sure.
So talk to us a little bit about that, because obviously we're in a higher rate environment. A lot of people are wondering if that has been a drag on returns and is going to remain a drag on returns.
Yeah, for sure. So there's no doubt that higher interest rate environment is going to have an effect on private equity returns. So when you think about the next couple of years, we do think private equity returns will be more subdued versus what you've seen in the past. Part of that is companies adjusting to higher cost of capital on the financing side of things. And part of that is really vintage concentration. And we spent a lot of time on this, where if you look at the pace of deployment the industry has seen in 2020, 21, 22, kind of through that period of ultra low interest rates, it was significantly faster pace of deployment than what we've seen in prior years. So those are going to be the returns. They're going to be harder to get back to this kind of 15 to 20% net IRR range, which is what most private equity firms tend to shoot for. So that's part of the problem for sure.
And if we think about that deployment challenge ahead, we hear a lot about dry powder and that there is a substantial amount of dry powder in the industry right now. Give us some context for how big that is and why that's such a challenge.
So dry powder, and just to kind of level set, it's effectively capital commitments that have not been put to work yet, right? So it's money sitting on the sidelines that LPs committed to, but private equity firms have not invested that yet. So today, globally, that's a $2.5 trillion number. It's a record by a mile. If you think about leverage on top of that, this equates to about $5 trillion of purchasing power. So substantial amount of capital that should be put to work over the next several years. Now, the challenge, of course, has been the fact that the pace of deployment has been really slow. And there's really kind of two problems with that. One is the industry ran way too fast in 2020, 21, 22. And just to put some numbers around that, in 2023, the pace of deployment slowed down to only about 40% of the dry powder relative to 50% annual average deployment pace as a percentage of capital available. In 2021, 22, that percentage was closer to 70%, right? So the industry deployed a ton during that period of time. So naturally, there's going to be a little bit of pullback. So that's the first issue. The second one, the bid-ask spread between buyers and sellers, while it's narrowing, is still probably a little wide. And back to your point about interest rates, that obviously has a lot to do with it. So certainty around rates is helpful. Credit spreads are tightening, so financing is becoming much more available than what we've seen in 2023. So all of that sets for a recipe for more deployment over the next couple of years. But for now, it's been pretty slow.
So we're basically saying there's too much capital chasing too few opportunities, and that in itself is going to be a drag on returns.
Yeah, I think that's part of it. I think that the bid-ask spread dynamic that we talked about earlier is an important factor here as well, where a lot of the deals in the sponsor community are sponsor to sponsor. So for a private equity seller to agree with a private equity buyer, they ultimately have to agree on a probably a lower multiple because the cost of capital is higher today than it was 3, 4, 5 years ago when that sponsor number one bought whatever that asset, right? So that's still a challenge and the industry is working this out through.
And so we've talked a lot about the deployment side. What about the fundraising side? There's tons of capital to deploy.
Yeah.
So are we just seeing funds pull back from fundraising?
Yeah, that's 100% right. So corporate private equity has been one of the harder places to raise capital in over the last 2 years now. In 2023, there's about $700 billion of capital raised. And while that sounds like a big number, it's actually the lowest annual amount since 2017. And there's really two reasons for that. One is there is this overallocation dynamic. So you probably heard a lot about this kind of denominator effect where the public markets have underperformed, the private market returns have been better. So a lot of institutional investors look like they're overallocated relative to their target. That is solving itself. Back to your first question around public markets, obviously having a really nice year. The bigger problem, I think, for the space is the pace of return of capital. So there's been very few realizations. And for capital to get called, you need to give people money back. And that's something that the industry continues to struggle with. Over the last 12 months, it's been one of the lowest paces of capital return to LPs. And similar to deployment, it's starting to look a little bit better, but we think it's going to be a long and kind of fairly dragged out process.
But do they necessarily need to raise as much given that deployment has slowed down? Or am I misunderstanding that dynamic?
No, look, I think the private equity firms are in the business of charging fees on capital that they raise, right? So they always want to raise more money. The reality, though, is to your point, there's a lot of dry powder on the sidelines, and there's a lot to kind of work through before we need to kind of raise incremental capital. We think that's definitely part of the dynamic in the space right now.
So if we take a step back and think about really the past decade where we've seen so much growth in private equity, new firms, new niches, bigger funds, is that growth sustainable? Like, is this a blip or is there some kind of sea change going on in the industry?
Yeah, I think there's two things going on. So first, just to kind of contextualize this a little bit, private equity industry is about a $10 trillion AUM space. And over time, it's been growing at a 15% a year annually. Over the period of 2021, 22, that growth has accelerated to 30%, right? So we've overgrown. And I think the period over the next 5 years is going to be getting back to normal. So slower growth, yes, but still growth. The second point that's important is where's that growth is actually going to come from? Because our view has been that US pension plans, which is a huge slug of investor dollars in this part of the market, are pretty full. So I think the growth is going to have to come from other channels, whether it's outside the US, Middle East, Asia in particular. Those are the two markets that are kind of younger and will probably be able to dedicate more time and resource and capital to this part of the market. The other one is wealth management industry. The retail investor, individual investor, however you want to define it, is still significantly underallocated to private markets broadly, including private equity versus the institutional marketplace. So when I think about the kind of change in allocations and change where the capital is going to come from, those are going to be the two areas that we think will be a lot more active. So firms that have more exposure to that part of the market should be able to grow faster than the ones that are more monoline and then perhaps too much exposed to the kind of US institutional channel.
But haven't retail investors historically been less invested in this space just because it's more opaque and it's less liquid? So is it appropriate for retail investors?
Yeah, and there are products that are being developed now to partially address that. So you're 100% right. There's been very limited participation from the pure retail investor in the space, but even the high net worth channel that could afford some illiquidity has not been super active in this part of the market. So what we're starting to see now is the more traditional funds, so GPLP style funds, XYZ firm goes out, raises $20 billion. There's more capital that's starting to come in from high net worth networks to the typical fundraisers. And then there's been a launch of semi-liquid products that will give you a little bit of liquidity up to kind of low single digit liquidity versus can't touch your money for 10 years. And that is really meant to address more like lower end part of the market, make it a little bit more available because the allocations there are pretty minimal for now.
Understood. And there's also other asset classes that are giving PE a run for their money these days, from what I understand. So are you seeing asset allocators move to some other areas of the private market space at the expense of private equity?
Yeah, I think it's part of this dynamic as well. And we've talked about private credit quite extensively, even on this podcast in the past. We think that's part of the difference this time around. So when you look at private credit markets today, given the fact that the base rate is in 5%, 6%, and on top of that, the credit spreads are in a 5+100 basis point range. So right there, you're getting almost a double-digit return being senior in a capital structure versus, back to the first question about the prospective returns for private equity, probably not going to be 20% over the next 5 years. So the spread between equity and credit has just gotten a lot more narrow. And being higher in the capital structure for effectively a lot less risk with similar type of returns just makes a lot of sense. So private credit probably taking some share from private equity. And we think there are other asset classes. Private infrastructure, for instance, is getting a lot of focus as well. So yes, I think there are kind of shifts underneath the overall private markets backdrop that are also unfolding.
Right. We also did a recent podcast on infrastructure for that reason as well.
There we go.
So if you think about the future of private equity, let's say over the next decade, will private equity funds make up a big share of the average investor's portfolio, or how do you see that evolving?
Yeah, private equity is not going anywhere, right? So private equity will continue to be a very sizable and important part of allocations. But we do think there will be one much greater dispersion between different managers. Back to that vintage concentration dynamic, I think that the returns that we're likely to see over the next 3 years, 4 years, will dictate which managers will be more successful in their ability to raise their next vintage fund, call it 26, 27, 28. So that's part of it. The second is, where's the capital going to come from? So we do think the big firms getting bigger is an important theme for the whole space. So LPs coming to GP for multiple solutions other than just looking at private equity will also enable some of these larger firms to gain share where they can construct allocation across private equity, private credit, infrastructure, et cetera. And then there's wealth. It's a channel that requires a lot of resources. It costs a lot of money to participate in and distribute through. And if that's an avenue of incremental growth for private equity firms, we do think the larger firms should be able to participate in that theme much better than some of the more monoline companies.
Right. So if you kind of summarize that and you think about the outlook for private equity companies, which ones are going to perform better and which ones are going to struggle over that decade you just described?
Yeah. So we like the more diversified firms. Bigger is better. I think that's one. I think the second is global. As we talked about, Asia and Middle East is a large pools of capital. They're going to be very additive to fundraising and exposure to wealth. So those are the three key pillars that we think will be very important when it comes to success of private equity firms going forward.
One last question is that the private equity firms themselves seem to be taking this in stride, some of them, and actually shifting their overall strategies to broaden out their mandate a bit. How are you viewing that?
I think acquisitions have been a little bit more prevalent in the space than we've seen in the past. And that goes back to the need to be multi-asset, to diversify, and to be more global. So we do think both organic and inorganic consolidation in this part of the market is likely to continue. We've seen a handful of deals in the space already where, call it the more monoline firms, let's say more private equity-centric firms, are trying to do more things in credit or infrastructure, and they're getting into that part of the market through M&A. Others are choosing to build it internally. That takes time. So we think consolidation in this part of the market is something that probably makes sense.
Alex, thanks so much for joining us.
Great. Thanks for having me.
I'll now turn to Mike Nichols and Gina Lytle from our Global Banking and Markets business to discuss what they're seeing in the deal-making environment and how private equity firms are deploying capital. Mike, Gina, welcome to the program.
Thanks for having us.
Thanks for having us.
So, Mike, let me start with you. Not too long ago, private equity was all the buzz. I mean, we saw eye-popping growth in the asset class and just really strong investor interest, very strong performance heading out of the financial crisis. But the last 2 years have been a very different story. So what's been going on and why such a large shift in fortunes for the asset class?
Look, I think the asset class certainly is not dead by any stance. We came out of the global financial crisis of the late 2000s, and it was a time where the industry had experienced a significant amount of growth, very accommodative rate policy around the world. And so if you think about that, the industry really got to a large size. Coming out of that, the industry is in a place where it's much more mature, right? And you've gone through an environment, the capital markets weren't as well functioning. LPs allocated a lot of capital to the space. That's been harder with lack of well-functioning capital markets, higher rates. It's been harder for a lot of those firms to effectively return capital to their LPs, their clients, at the end of the day. And so that's really, for lack of a better word, gumped up the system, if you will, in terms of the amount of capital coming back to them. I would say that if you think about where the industry's going, it's a cyclical space. And we think we're in the middle of a cycle now. And I think there's a lot of runway looking forward for the space to grow in a meaningful way from here.
Just to get a little bit of background, a lot of people think of private equity investments as ones where you actually are not going to get your money back for a long period of time, right? These are generally long-term investments. So just talk us through, though, what that cycle usually looks like and what it looks like today then.
Yeah, sure. It's interesting. So typically there are, plus or minus 10-year funds where you typically have a 5-year investment period and a 5-year sort of what I'll call harvesting period for these funds. Now, as the run up to, say, the end of 2021, what you had is firms raising money year over year more quickly at larger sizes. And so people became very allocated to the space overall. I think what we're seeing now is more of a reversion to what's more normal in terms of a fundraising pace and a fundraising step forward. But having said that, given the amount of allocations that people made in the past, i.e. clients made to the space in the past, they need to see some of that capital come back to them before they can actually move things forward.
Right. So these are clients that invested several years ago and now want to see some cash.
Yes.
Understood. Gina, Mike briefly mentioned the higher rate environment. Let's talk about that a bit more directly because, of course, it's now looking less and less likely that the Fed is going to cut interest rates substantially this year. Some are even saying that they won't cut at all or they'll even hike. How much does that really matter? Do private equity firms need lower rates to perform?
So taking a step back since the great financial crisis through to the beginning of 2022, the industry had the strong tailwinds. They had good macro conditions. We had a low cost of borrowing and the strong consumer. That was a good environment that was conducive to deal making. Now, as we've moved forward the last 2 years, it's been more challenging. There's been less certainty, and we've had 11 rate hikes. And so that's driven up the cost of financing, and it has hampered deal making. And so where we sit today, it feels like there's less uncertainty to what we just experienced so rapidly over those 11 rate hikes. And we're starting to see a path to cuts. And that's going to create a more robust deal-making environment.
Right. So we're still facing a higher cost of capital, but the uncertainty around the rate path is much lower.
Exactly.
Understood. But I remember a year ago talking about this big valuation gap and essentially view of the world between buyers and sellers having just a much higher price in mind than buyers. So is that still the case, or how has that gap evolved? Has it narrowed? Mike, what do you think?
What we actually see is people become what I'll call more realistic around what's the equilibrium around needing to return capital on one hand, wanting to achieve the best outcome on the other hand in terms of value. And so what you actually see is people transacting where they think they can get a very good return. Maybe it's not the best they possibly could have gotten, but there's a balance between actually holding onto the asset for longer and really playing things forward. And so we've seen that converge a bit. One of the other things that we've seen a lot of is really public to private deals in terms of private equity firms taking a lot of public companies private, i.e. where the private market kind of sees value vis-a-vis where the public market stands and really seeking to capitalize that and then going through whatever the particular private equity firm's playbook is to make any of these portfolio companies enhanced in terms of performance.
And that really was the traditional playbook, right? Like we would see a PE sponsor buy a non-public company, they'd grow it, they'd improve it, and then it would go public. But as we all know, the IPO market has actually been pretty slow. So how big of an impact has that had on the industry and deal activity?
I think that's been a very big impact on the overall industry because you basically take away one of the big pillars in terms of people getting liquidity on these assets over time. And I think obviously we've seen some green shoots in the IPO market. We expect that hopefully to continue over time. And our expectation is that sponsors will look to take advantage of that as time plays on, in particular for larger assets that don't really lend themselves to being sold to a strategic or being sold sponsor to sponsor, if you will. And so we definitely think that's a trend that will pick up over time, but it's certainly one of the big sleeves that people have had less of an option of using over time. And again, the drumbeat of needing to generate liquidity will only increase over time. And like all markets, you have a cyclicality to the IPO market. And so as we see more and more deals get done that are constructive, that'll obviously open the aperture, if you will, for other people to consider going down that venue.
So where are the types of deals that are getting done? What do they look like? And where are investors most focused right now?
It's amazing how much the industry has changed. On the exits that we've been seeing, PE managers are getting more creative given those three primary exit channels for them have been challenging. Those exit channels are selling the asset to another sponsor, selling the asset to a strategic, or taking companies public. So we're seeing a general trend of companies that are staying private for longer. And we're also seeing a lot of minority and co-control deals where they're partnering with other sponsors. They're looking to do continuation funds. They are looking to structured equity solutions and fund financings. And so there's a lot of innovation and creativity that sponsors are bringing to the table.
When you say continuation funds, what is that?
Sure. Look, the secondary market for these assets has continued to evolve over time. You can think about a wide spectrum and it continues to grow, which is to say, if you think about LP secondaries, i.e. clients who want to get liquidity against broad level of positions across different funds, that's a long-standing market where people can, deep market where people can sell their positions in size, typically at a discount as part of that. There's also what we'll call the GP-led market or continuation deal market, where a sponsor has an asset in these days, typically an asset that is well-performing, and they effectively get outside investors to come in as part of, they set up a special purpose vehicle, get outside investors to come in and effectively roll a lot of their own economics in terms of carry into the vehicle and allow existing LPs to get liquidity as part of that. And you're seeing that happen a lot more. We think that's a concept that has real staying power within the industry. You've also seen the rise of net asset value financing, i.e. loans, against the portfolio to use for purposes of distributions and also to do strategic add-ons for the portfolio. And then there's other structured investments that people have thought about more broadly in terms of finding liquidity solutions in the context of the space.
And so when we think about that secondary market in general, how big is that?
I think about the secondary market as a very, very large market, $100 billion plus type market annually, where you're effectively in a place where that's going to continue to grow. If you just think about the private market ecosystem, broadly speaking, if you take a view that it's going to grow over a period of time, which seems to be the general consensus, we could debate the level of growth within each asset class, but we think that's going to become a vital part. And then some of the structures that we talked about beyond the traditional, what I'll call LP secondary market, i.e. client liquidity market, if you will, on the private side, we think that's going to continue to grow over time.
Okay, interesting. Let's pivot a bit to talk about the actual business of private equity. If we think about the macro and deal-making environment we've been discussing, how has that affected private equity's strategic decision-making?
Given the size and scale of the industry where it sits today, inherently, the growth in the space is going to be slower, all else equal, going forward. And again, sometimes it'll be faster, sometimes it'll be a little bit slower, but all else equal, you probably have taken one step down in terms of growth overall as you look forward over a period of time. Having said that, I'd say in our own dialogues within the industry, people are of two minds. One, they stay in their lane, they do what they do, and they're really excellent at it. And there's always going to be a home for people who have produced really, really good returns and are in a really good place. Now, obviously, there are broad macro factors that could force performance into a more negative place at a point in time. And so people have to be willing to live with that. And on the other end, you certainly have players who think about, should they have a more diversified platform, things like alternative credit, private credit, things like infrastructure, things like real estate. I do think clients look at private equity now in the days that we're in terms of what is the expertise, what is the value add, what is the ability of a firm to manufacture returns in terms of actually driving value at the portfolio companies. And I think that's going to be much more of an emphasis going forward, quite frankly, than it may have been over the last 10 plus years, within the year ended 2021.
So what are you watching, Mike and Gina, that would make you more optimistic about the space into the second half of this year, into 2025, or less optimistic?
Yeah, I think there's two things that I'm looking out for. One is a sign that we'll see lower rates at some point in time. And it doesn't have to show up immediately, but something that, at least there's some glide path on that people can see. And then second is more well-functioning markets where people have the confidence to sort of access them. Because I think once you get the flywheel moving in terms of more liquidity for the assets, certainly more tailwind for valuations and so on and so forth, I think that gets the flywheel moving again. which basically allows for clients to continue to allocate. I think some of the factors that we talked about in terms of where people are, in terms of being more discerning, in terms of who they're allocating to, and so on and so forth, I think that will persist. I think we've entered just a more mature part of the movie, if you will.
Mike, Jana, thanks so much for joining us.
Thanks so
for having
much.
us.
This episode of Goldman Sachs Exchanges was recorded on Monday, May 13th, and on Wednesday, May 1st. I'm your host, Allison Nathan. If you enjoyed this show, we hope you subscribe on your platform of choice and tune in next week for another episode. And if you want more insights from Goldman Sachs, make sure to visit gs.com and sign up for Briefings, a weekly newsletter from Goldman Sachs about trends shaping the markets, industries, and the global economy. Thank you for listening. The opinions and views expressed in this program may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Each name of a third-party organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. The content of this program does not constitute a recommendation from any Goldman Sachs entity to the recipient and is provided for informational purposes only. Goldman Sachs is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. Certain information contained in this program constitutes forward-looking statements, and there is no guarantee that these results will be achieved. Goldman Sachs has no obligation to provide updates or changes to the information in this program. Past performance does not guarantee future results, which may vary. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed.